Hey everyone, welcome back to Corporate Decoder, the place where we rip open financial documents to find the real story, and today we're digging into Beyond Air Incorporated's latest proxy statement. Get ready because this filing has a lot to say about where the company is headed, especially when it comes to their employee incentives and financial health. And if you like getting these kinds of straight up, no fluff breakdowns, make sure you are subscribed and join our Discord community linked in the description below where we dive even deeper. Alright, so what is this big document? It is a proxy statement, which basically means the company is asking shareholders to vote on important stuff at their upcoming annual meeting. Think of it as the agenda and explanation for a big shareholder party. And the company putting this out is Beyond Air Incorporated. They're giving us the rundown on everything from electing new directors to approving their incentive plans. Mark your calendars, folks. The big meeting is set for the 30th of January 2026. Now, what are they asking us to vote on? First up is the election of directors. These are the folks who steer the ship. Beyond Air wants to elect 6 of them and keep them in place until the 2027 meeting. Next, they want to ratify or approve their accounting firm, Smith the Brown PC. This is like getting the nod from the shareholders on who is going to check the company's financial homework. This is a big one. They want shareholder approval to increase the number of shares available under their equity incentive plan. This means they want to issue more stock options and grants to employees and executives. They're asking for an extra 850,000 shares for this. And then there is a proposal that basically says, if we don't get enough votes or we don't have enough people show up, give us the power to postpone the meeting. It is like a backup plan to make sure they can get things done. Now, who gets a say in all this? If you own shares on the 3rd of December 2025, you are on the guest list for voting. As of that date, there were just over 8 million shares floating around. Each share gets 1 vote. Let's talk about voting. If your shares are held by a broker, this is where broker non-votes come in. If you don't give your broker instructions, they might not be able to vote your shares on certain issues, leading to these non-votes. It is important to give your broker clear directions. So, what does it take to pass these proposals? For electing directors, it is a plurality vote, meaning the folks with the most votes win. For ratifying the accounting firm and approving the incentive plan, it is a majority vote. Abstaining or not voting essentially counts as a no vote on those proposals. And to have a valid meeting, they need a quorum, which is basically half of all the outstanding shares represented either in person or by proxy. Voting is pretty standard. You can vote online, by phone, or by mail. And if you are attending in person, you can vote then too. Just make sure to bring your ID and if you hold shares through a broker proof of ownership. Yes, you can always change your mind. Up until the meeting starts, you can revoke your proxy and cast a new vote. Election of directors, alright. Let's look at the people who want to be on the board. They're proposing 6 individuals. Stephen Lisi, the CEO and chairman, has been around since 2017. He's got a deep background in business development and finance, especially in healthcare. The board thinks his experience makes him a qualified director. Then there is Robert Carey, who actually helped start another biopharmaceutical company, Accession Incorporated, and has a ton of experience in healthcare investment banking. He has been involved in raising billions for biotech companies. He is also on the board of Sangamo Therapeutics Incorporated. Dr. William Forbes brings over 30 years of experience in pharmaceutical product development. He's been Chief Development Officer at several biotech companies, so he knows the science side really well. Yuri Lee co-founded Trio Health Advisory Group Incorporated and spent over 15 years at Leerink Partners Incorporated, a big healthcare investment bank. Her experience in healthcare advisory is what the board values. Eric Lucera has a strong financial background, having served as CFO for several biotech companies like Dyne Therapeutics Incorporated and Editas Medicine Incorporated. He's also a CFA, CMA, and CPA, which means he's pretty much a financial whiz. And new to the board is Robert Goodman, who joined in June of last year. He's got over 30 years of executive commercial leadership experience in healthcare and life sciences, and he's even helped with FDA device approvals. They're all nominated to serve until the next annual meeting, and the board unanimously recommends voting for them. Ratification of appointment of independent registered public accounting firm. Next up is endorsing their accounting firm, Smith the Brown PC. They were appointed after another firm, Markham LLP, was dismissed. The company reassures us this dismissal wasn't due to any disagreements on accounting practices. Looking at the fees for the fiscal year ending the 31st of March 2025, Withum was billed around $425,000 for audit fees. This is up from about $325,000 the prior year. It is a pretty standard increase as companies grow or deal with more complex financials. The audit committee, made up of independent directors, has reviewed the financials with management and the auditors. They're saying the audited financial statements should be included in their annual report. They've also got a whole list of duties like hiring auditors, reviewing audit plans, and checking internal controls. Approval of the 8th amended and restated 2013 Equity Incentive Plan. Now back to that big one, the Equity Incentive Plan. Beyond Air wants to add 850,000 shares to their existing plan. Why, they say they need more shares to attract and keep talented employees, consultants, and directors. They believe that having enough equity to offer is a crucial tool for recruiting and retaining top talent. And if they don't have enough shares, they might have to offer more cash, which could hurt their financial performance. As of the 3rd of December 2025, they had about 726,000 options and 18,000 restricted shares already out there. Plus, they had only about 10,000 shares left to grant. That is not a lot. Adding 850,000 shares should give them enough to last about 12 months, they estimate. This plan has been around since 2013 and has been amended several times. The main change now is just adding more shares. The plan summary also touches on the tax implications for participants. It explains how different types of awards like incentive stock options, non-qualified stock options, and restricted stock units are taxed. It is pretty standard stuff regarding ordinary income versus capital gains. It is no surprise that the company's execs and directors have a vested interest in this plan getting approved, since they are eligible to receive awards. Speaking of execs, let's look at how they're being compensated. This table shows salaries, restricted stock units, and stock options for their top executives. For Stephen Lisi, the CEO, his salary in 2025 was about $555,000, and his total compensation, including stock awards, was around $821,000. In 2024, it was much higher, about $1.7 million, mainly due to stock options. This shows how much of their compensation can fluctuate based on stock grants. Amir Avniel, who was president and chief business officer, earned about $522,000 in total compensation in 2025 before resigning. His 2024 pay was also higher, close to $1 million. Michael Gall, the Chief Operating Officer, saw his total compensation around $464,000 in 2025, down from $799,000 in 2024. Again, largely due to stock-related awards, Douglas Larson, who was the Chief Financial Officer, received about $405,000 in 2025, down from $692,000 in 2024. He resigned recently, but will continue in an advisory role. This pay versus performance section is always interesting. It compares compensation actually paid to executives with how the company performed. And here is where things get tricky. For 2025, the CEO's compensation actually paid is a negative $792,000. That sounds wild, right? It is because this calculation subtracts the value of unvested awards from the total compensation reported. It doesn't reflect cash taken home, but rather adjustments to the fair value of stock awards. Meanwhile, the company reported a net loss of $48.8 million in 2025, a loss of $64.3 million in 2024, and $59.4 million in 2023. The compensation actually paid being negative is a really weird accounting adjustment that often happens when stock values of unvested awards fluctuate significantly. It does not mean the CEO paid money back to the company. Adjournment or postponement of the annual meeting, if necessary, to continue to solicit votes. This is that adjournment proposal we mentioned earlier. If they don't get enough votes for other proposals, they want the power to push the meeting back. Now, who actually owns a big chunk of the company? We see major shareholders like Aliska, Avenue Capital, and Atlas. Aliska holds about 9.99% and Atlas holds about 7.2%. And of course, management and directors own shares too. Stephen Lisi owns about 7%. Robert Carey, a director, holds a significant amount, around 9.99%, likely due to his loans to the company. It is interesting to see how much insiders hold, showing their belief in the company or their involvement through financing. This section details transactions with people related to the company, like directors or major shareholders. It looks like they have loans from key figures. For instance, Robert Carey loaned them $7.5 million and Stephen Lisi loaned $2.5 million. In return, they received warrants, which are like options to buy stock, later at a set price. This is a common way for companies to get financing from their insiders when traditional avenues might be limited. More recently, they restructured loans from Mr. Carey, which involved adjusting the price of warrants. This is a quick note on filing compliance. It seems like most directors and officers filed their ownership reports on time, except for Stephen Lisi and Robert Carey. who had a late filing for a private placement transaction. Finally, they point to their annual report for more details. Now for the nitty-gritty on that equity plan they want to approve. This is the actual document outlining how the plan works. It reiterates the plan's purpose to attract and retain talent, incentivize performance, and align interests with shareholders. It can be used for stock options, stock appreciation rights, restricted stock, and more. If approved, the plan will allow for the issuance of up to 1,680,000 shares in total. This includes shares already awarded and the new ones being added. The Compensation Committee will manage the plan, deciding who gets what and under what terms. Employees, consultants, and non-employee directors are eligible. This appendix also dives deeper into the US federal income tax consequences for various award types like incentive stock options and non-statutory stock options. It is pretty technical, explaining when you pay taxes and at what rates. For example, with incentive stock options, you typically don't pay taxes when you get them or exercise them, but you will pay capital gains tax when you sell the stock, as long as you follow certain holding periods. Non-statutory options are taxed as ordinary income when exercised. There is also a specific annex for Israeli tax residents. This part details how options granted to Israeli employees will be treated under Israeli tax law, including different options for capital gains versus ordinary income tax treatment and the role of a trustee to hold the shares. Alright, let's zoom out and give our take on Beyond Air Incorporated based on this filing. The company is clearly trying to incentivize its team, which is essential for growth, especially in the biotech sector. The proposed increase in their equity incentive plan suggests they believe they need these tools to attract and keep skilled people. The fact that they expect this new pool to only last about 12 months might signal ongoing high turnover, or aggressive hiring plans, which can be a double-edged sword. It shows ambition, but also potential instability if not managed well. Financially, the company is reporting losses, which is not uncommon for a company in its stage of development. Particularly in biotech where research and development are costly, the convoluted compensation actually paid, figure being negative, is an accounting adjustment that, while technically correct based on how they calculate it, can be confusing. It highlights how much of executive compensation is tied to stock awards, whose value can swing wildly with market conditions. Rather than straightforward cash, the insider loans and warrant issuances, like those from Robert Carey and Stephen Lisi, show that key stakeholders are willing to put their money where their mouth is, which is a positive sign of confidence. However, it also means a significant portion of their stock ownership is tied to these financing arrangements, which could have implications for their voting power and the company's financial flexibility down the line. Overall, Beyond Air seems to be in a phase of strategic growth and talent acquisition, leveraging equity incentives heavily. The board slate looks experienced with a mix of operational, financial, and scientific expertise. The main question will be whether their ambitious plans translate into strong financial performance in the long run, and if they can navigate the challenges of a biotech landscape that demands significant capital and time to bring products to market. What are your thoughts on Beyond Air's strategy and their upcoming votes? Let us know in the comments below. If you found this breakdown helpful, please hit that like button, subscribe for more deep dives into corporate filings, and join our Discord community linked in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.